We're excited to be having an insightful discussion today on the industrial real estate landscape and what we're seeing out there today in today's market. I'm Matt Woehnker, President of Four Springs Capital Markets, and I'm joined today by our Head of Acquisitions, Jared Morgan. Jared has over 3 decades of experience within the real estate and industrial marketplaces, and a decade of which has been spent here at Four Springs. So I'm really excited to have him share what he's seeing in the market. And, Jared, maybe if you wouldn't mind just sharing a little more about your background with our audience here today.
Absolutely. Well, it's wonderful to join everyone. My name is Jared Morgan. I head up acquisitions for Four Springs. As Matt noted, I have over 30 years of commercial real estate experience. A lot of that has been in the industrial space. The past 18 years, I've been solely focused on acquiring single tenant net lease industrial assets. I've done that for both private as well as public institutions, buying assets throughout the country. And glad to join you and talk to you about how I underwrite and how I look at real estate assets within the industrial sector.
Excellent. Yeah, looking forward to it. Would love to highlight some additional items about Four Springs 1031 Exchange as a sponsor. Last year we actually celebrated our 10th anniversary, so we've been around now for over 10 years. We have about $1 billion in total assets under management. Thanks to Jared and his team, we have acquired over 60 different properties over that time frame. That's been within over 30 different DST offerings. Also today we have now over 1,300 investors within our own proprietary investor portal. So we've experienced quite a bit of growth as of late. We're connecting with our advisors and investors regularly, and part of why we're excited to hear from Jared. But with the 60 properties that we've acquired over the last decade, I'm sure there's probably some key highlights or maybe some favorites that you wouldn't mind sharing some stories with.
Yeah, absolutely. And thank you for that background for us as a sponsor. We've been a very active buyer of net lease assets with a heavy concentration within the industrial sector. We've bought industrial deals through our platform that range from brand names that everyone knows, from Amazon to Ford to JF Roofing, which is a pretty common industry name, to dominant regional players that are non-investment grade but private, strong regional credits that are critical to whether it's manufacturing distribution within the U.S. market. A good example of that is our Industrial 27, where we acquired 24 assets, of which there were 15 unique tenants within that portfolio and a master portfolio of industrial assets. So we target all industrial class assets, and just to kind of give you a list of what's out there and what investors target. There's traditional distribution. So you think Ford, you think Amazon that's shipping products out of their facilities. There's core manufacturing. We've got companies like Abrasive Technology and core regional and national players that are making goods and services for the U.S. consumers. Cold storage, that has been a very favorable sector over the years. Domino's is a tenant we own within the cold storage space. And lastly, the IOS sector. Equipment rental is one of our tenants. IOS is the new hot sector. It stands for Industrial Outdoor Storage, and it's where you've got perhaps a smaller building on a critical larger lot that's housing a product like JF Roofing supplies or vehicles. Our Ford facilities carry a lot of trucking capacity on those locations. So IOS is kind of the new and hot in industrial sector.
Excellent. Thanks for the added color. It'd be great. Let's start shifting gears and really kind of get into the bulk of our conversation here. Curious, what trends are you seeing in the industrial real estate sector? How are they influencing investment opportunities for 1031 exchanges as well?
Absolutely. So, industrial has become one of the hottest sectors within the real estate market, within the space. Really going back to 5-7 years ago, we had a lack of interest from institutional as well as mom and pop buyers into the space. The American economy itself has really evolved. It's evolved how we make, how we distribute, how we store products. And the driver of that, from a real estate standpoint, are these industrial boxes that really house these operations, these tenants. If you look at COVID, I mean, that was a real shot in the arm for the industrial market as demand skyrocketed just for space. Everyone knows the buzzword onshoring. It is a reality. More product is being made and held here in the U.S., and therefore there's more space demands for that product. And it really has not slowed down since. And there's been some headwinds, and I'll go into that as part of this conversation today. But it remains really a favored asset class. You think about demand for this asset class from a buyer standpoint. So you're looking to get into the space. Who's actively acquiring and been acquiring industrial? It is a favored asset class within institutional investors. When you're thinking the life companies, pension funds, they've been actively acquiring bulk core portfolios. Public REITs, there are numerous industrial-focused public REITs that have been growing over the years, have done very well. Private equity, monster shops to smaller mid-cap private equity firms have been very active in the industrial space. And foreign investors, it's been a favorite asset class within foreign markets that want to own on U.S. soil and see industrial as an asset class they want to have more exposure to. Now, what this means for your 1031, your smaller buyer, it's competitive. It's more difficult to get in and invest in this type of space because of the demand for this type of quality product. Therefore, it's not as much money to get allocated into industrial because these big groups are swallowing up a lot of the product. One of the great things about our offerings, for instance, DSTs, is that allows you to take ownership in a larger project like an Amazon, like a Ford, so that we're acquiring, underwriting high quality, high profile asset. We're able to compete with these large institutions and through our relationships, take deals off market and then offer that out to the 1031 community.
It's great. Yeah, it is really incredible, the access that it provides, the advisors and investors that we work with on a daily basis. Could you discuss the growth drivers for industrial real estate? When an investor is looking at an opportunity beyond just real estate fundamentals, what are some critical factors? How's the industrial world changing?
Yeah, certainly. And beyond real estate fundamentals, I do want to address real estate fundamentals. And I think we'll get into that a little later in the conversation because it's critical to have a good basis going in. But let's talk about some global major factors to consider when looking at industrial opportunities. So buzzwords, e-commerce, supply chain evolution, that's all driving it. The need for boxes to hold product, to distribute product. Nearshoring. Nearshoring is something that came out of COVID, and now in light of this world with tariffs and all the discussions that are happening from a political standpoint, having U.S.-based operations, industrial operations, becoming more critical than ever. Items with high barriers to entry. And I'll give an example of that when I kind of finish going through my list here of important components, but that is important. You can find an industry that's difficult to get into in an industrial player that operates within that. Drive times. So trucking is still the blood of this country, and the truckers need to be able to have within a one-day drive, facilities, locations, access to that. And that leads into infrastructure and access. You need to have a quality highway system, ports, bridges, all the different components that go into it. And then ultimately power. Power is a massive discussion right now. I mean, it's obviously big in the data center world, but also applies to industrial users. The demand for power that a facility in a region might have. Given examples of those and some of the DSTs that we've done, I think of access, so rail access. Rail is still an important part of the industrial workforce in the U.S. economy. We've got an asset, GAF, which is a major roofing company, so heavy, bulky items. Their build to suit Indiana was specific to having rail access, not just for the U.S. market, but also for up into their Canadian customers. So that was something we underwrote as valuable. We have another tenant, Liquid Box. If you think of, you go to Dunkin' Donuts or Starbucks, that liquid box that coffee comes in, that's what they produce. Pretty basic item, but it takes a lot of plastic to produce, and that plastic is coming in off of rail lines in the Ohio market. So again, another sticky tenant that we liked because of the access requirements. So those are some examples. From a power standpoint, we have Amazon in Grand Rapids as well as Austin that both have sub power stations next to them for redundancy, for backup, for additional power needs. You think a lot of these distributors are using more and more electric components in what they do, it's going to generate and require more power. So it's something that we look at and underwrite is current capacity, future capacity an area has to provide. And lastly, I mentioned high barriers to entry. I'll give you a great example. We did a deal, one of our earlier industrial DSTs was with Harper Distributors. They distribute beer to half the state of Connecticut. So they've been doing it for years, there's a lot of longevity and history with the client. but also just the laws within the state and around liquor distribution and Anheuser-Busch being the parent supplier. All of that made it very sticky and made a high demand and need for that space. So we underwrote that beyond just the quality of the box, which has a cold storage component to it, but also the fact that to go in and replicate that would be extremely difficult from another user. So that gave us great comfort and support in our tenant and the quality and the longevity of that location for them.
Great, excellent. Shifting gears a little bit here, so that might be viewed as a headwind. As of Q4 of last year, 24, the U.S. industrial real estate sector has experienced a notable increase in vacancy rates, reaching 6.7%, which is up from 3% just 2 years prior. Why is that? Any additional color you would mind sharing with the group today?
Yeah, absolutely. And it is a hot sector. And with every hot sector, eventually you'll have some flaws in it. And I think right now, biggest flaw in industrial is there's been overbuilding. Okay. There's pressures on investors to understand what those flaws are so they can anticipate them on their future investments. From an oversupply standpoint, hot market is Florida. Population growth has really skyrocketed there, and hence the demand for more industrial boxes. In 2023, I believe there were about 40 million square foot spec facilities delivered to the market. A lot of those are struggling to be filled right now because there was just too much product to the market with a lot of cheap debt going back to 21. That kind of flooded the market. As a result, those boxes are being broken up and they're trying to release them to smaller tenants. A specific case point there, but something that kind of help investors understand where you might have issues within the market. Now, that being said, as far as million square footers, according to CBRE, the top 100 leases by size signed in 2024, half of them were 1 million square foot plus. So there is still demand for that. You just got to make sure to identify the right markets where there's not an oversupply that might pressure, or sign with a long-term tenant so you have longevity in that leasehold, that lease obligation from your operator. The next is economic uncertainty. Look where rates are now. When we were doing deals in 2021, debt was sub 3%. Now it starts at 6% and above. Just the fact that the cost from both construction loans to the takeout perm loans we're putting on this, it's grown dramatically. So that really put pressure on the ability to clear assets, develop assets, all aspects of industrial market that is driven by rates. I did note spec development. There really has been no spec development lending over the past 2 years, and it's extremely difficult to get that. So that is actually going to help limit supply. So I think it will help the market going into 25 as there is less supply because of those economic constraints of higher rates. And lastly, I'll stress the vintage, the quality of the building. Old industrial buildings are fine, they work, but you want to make sure you've got a box that's functional. You want to make sure that you've got the right ceiling height, you've got parking, you've got power distributed to that facility. You really want to make sure if it's an older facility, not something that's built to suit specs for that operator, that you've got a quality box in the market. Lastly, construction costs, and we'll throw up a slide that kind of shows the spike in cost. There's been a 38% increase pre-pandemic cost of overall construction for industrial. What does that mean? That means the land cost. You start with land, that is really skyrocketed. The steel that goes into it, the roofing materials go into it. Concrete had a huge spike years ago that really impacted developers, and that building not only the slab, but all that outdoor space that is associated with industrial. So all those factors are pressures on industrial, and it's important to understand the negatives with the positives. But that being said, let's look at some of the positives that offset that. Despite the high vacancy rate, if you look at rents on a national average, so I'm going to reference the Wall Street Journal. In 2019, your average rent rate per square foot was $6.09 across the U.S. Today, 2025, that average rent per square foot for industrial space is $10.13 a square foot. So, we see tremendous upward rise of rents, and we see that pressure continue, especially in supply-constrained markets where it's hard to find some boxes. And even that Florida example I gave you, where they're splitting up spaces, those smaller spaces are actually demanding more rent, mid-teen rents in certain locations because of lack of that size product potentially in the market. Also, one thing to note is that more companies are focusing on, they want newer industrial product, but they want to create efficiencies in what they build. Our recent deal, Ford, is a great example. That's a consolidation of all their parts distribution throughout the U.S. Right now, about 70% of their parts distribution is being held out of our facility, and they anticipate getting up to close to 100%. They built out that facility specifically for that function and utilizing technology to do so. They spent around $70 million of their own money to build out that space, from advanced racking to distribution to robots that go through and sort things. That is what they see as the future, and they're investing in it. And as a result, they're willing to put a lot of capital into an industrial box that, as a byproduct, we can own and control for a long term.
That's great. I've taken some notes on some of what you're sharing with us here, Jared, and you were starting to touch on interest rates, right? It's been a very interesting interest rate environment, to say the least. What impact do interest rates and inflation have on industrial real estate valuations as well as cap rates?
Yeah, I mean, you look at the marketplace, and at the end of the day, the debt markets really drive all value across all sectors of real estate, not just industrial. The cost of finance an asset, even when you're buying all cash, it drives where people look for a yield. So obviously, rates go up, prices are going to drop, cap rates will go up. We've really seen cap rates rise over recent years through all sectors. Industrial's probably been a little bit less than other sectors like office and retail, and we've seen the stats to provide that, to prove that. But we actually did see a slight compression in cap rates in industrial in Q4 of 2024, and that was, my theory, was part of that rate drop that we saw going back to August into September and October, where I think the 10-year Treasury hit 365 at one point, and there was a flurry of activity to invest and try and lock in rates. Since it was 10 years at about 4.5%, so things adjusted upwards again, which I think slowed down volume in December into this year. But it kind of shows you the impact debt has on transaction volume and valuations on industrial real estate. And that's one of the reasons we like long-term leases, because it gives us a stability of cash flow, longevity in our ownership and in the lease term, but also the debt we can place on that. We can do a longer-term financing on an asset so that we can ride out these ebbs and flows in the market as rates continue to fluctuate up and down. And one thing to also note is that right now in the marketplace, we're an active buyer, constantly bidding new opportunities. We've got a group out there that they need to be sellers. They've got a construction loan that might have a year left on it, on new product that they've built with brand name type credits. The market right now is probably 30 to 50 basis point separation between the buyers and the sellers, where the sellers want to clear and where we want to get our yield locked in on long term. So, the deal volume is definitely slowed down because of that. What happens in the near term, if rates move, that'll help, but also there's pressures on sellers that ultimately need to clear product into the market. They want that liquidity, they want that capital back to go build that next industrial box. So we're starting to see some movement, but it's been a bit of a stalemate over the months because of the high cost of debt.
So, yeah, thanks for covering that, Jared. Something that's interesting, just with listening to what you're covering and sharing with us, is looking at industrial real estate, right? And how could that really enhance diversification from a 1031 exchange perspective? And what I'm hearing, I think there's it can really provide resilience across a variety of market cycles, right? From enhancing diversification, stability. You've got industrial real estate, how that's reducing sector concentration risk.
Mm-hmm.
And again, like I was just mentioning, the strong performance in a variety of market cycles. You've got, to your point earlier, e-commerce, supply chain growth.
Mm-hmm.
And then there's, not to mention, the stable cash flow and tax efficiency coming from that as well in that particular sector.
Yeah.
So all really great points that you're sharing here. Another topic that I'd like to cover, just from hearing conversations out in the field, it seems like more tenants are signing net leases. I'm curious on your take as to why, but what is the most significant shift you've seen in the industrial space since you started in addition to that?
Yeah, I think first to look at us as buyers of this type of asset class, again, whether it's institutional, it's Forest Springs, we're looking for long-term commitments that are financeable. Right? That's where we're willing to go in and take down assets. And I think the developer market, as well as the tenants they represent, understand that the best value is in having that long-term, because that's what the clearing market, us as buyers, demand. So, we're driving a lot of that on how we're trying to structure these deals. But on the tenant side, they want more control and longevity than ever in their assets. And why? Well, I give a good example. You put $70 million into a state-of-the-art port facility. You want to make sure you have a long runway to amortize those costs out and to grow into your business thesis. So we're seeing tenants more willing to sign those long-term leases because of the quality of box they're having built for them. And what they're doing in that box and wanting to be able to stay in there for the near future, long-term future.
Great. What about, are there specific geographic regions or markets that you're prioritizing for acquisition purposes? And how should investors really look at local markets and their impact on real estate?
Yeah, I'll pull up a slide. This is a slide we utilized. Collier's actually put this together for us. As part of his financing package. We were really starting looking at our Ford transaction, and it represents that access, transportation, all the things I was kind of laying out and how you underwrite an asset. This gives an example of how we look at something and how this location is so critical, not only to the Ford distribution system, but any other user that might want to utilize it, depending, no matter what they do, not just automotive related. So a great example of the highways, the ports, the bridges, all the components you want to understand that's around you. I noted that one-day drive for truckers, how can they get their goods to where they need to go? So something to look at, and that's just not in Detroit market, but across the U.S. as you look at industrial opportunities, looking at that infrastructure and using this slide, this idea of what's around it and how's everything flow around it from ports to trucks to rail. So I did note that one-day drive time is critical. Tariffs. So tariffs they're very active in everyone's discussion today as a political topic, and it's something potentially real that's going to impact our border communities with Canada and Mexico. As a result, there's been a lot of discussion about building close to border towns. Detroit is close to the Canadian border, but also you think Texas and Arizona, where you can build warehouses that have they're on U.S. soil, access to those foreign goods. So more and more product can be held here in the U.S. for longevity and potentially impact the cost structure. Now, that being said, I will stress, this is a 4-year term, and we don't know the longevity of this. So if you're buying based on that thesis, just understand your box should be appropriately priced so that if that were to change, there's still value in that location that you have. So it's a hot topic right now. People are kind of racing to that thesis, but as everything, especially politically related, things can change quickly and impact your investment. Labor pool is critical. You really want to look for what that operator does in that industrial box, what that labor force is and where they're drawing from and the costs associated with that, and really understand the region they're in, the market they're in, and the dynamics that motivated them to be there in the first place and will keep them there long term. And labor is a huge factor. And lastly, customer base. Certain industrial boxes are servicing areas. So you want to understand what that customer base is, how long it's been there, what they're going to grow into, and why they want to be there. This all leads to the stickiness of understanding your tenant, how that box relates to them, and creating that long-term commitment that we as investors are looking for in industrial spaces.
Great. Fantastic. I do notice we are receiving a couple questions through the WebEx. So folks obviously are encouraged to enter. We'll try to address a couple of these here. But before we get to that, we'd love to kind of get back to the basics a little bit with you. What are the key criteria you look for when evaluating potential industrial acquisitions?
Yep. Okay. Well, let's talk about all these factors we've been talking about and kind of pull them together and just kind of underwriting criteria. And how we look at it as a team here at Four Springs is, and I've referenced this a lot in past webinars discussions, it's to us the three legs of a stool. So let's start with the first leg, and that's real estate. And I had said earlier, we're going to go back to basis and fundamentals. Well, that's the real estate fundamentals you're buying at. So rent per square foot. We talked about the national average. You want to be at or below. You don't want to run into an instance where the developer, the builder, whoever it might be, has plowed all the tenant improvements into the rent, and you have an outsized rent. Because you always want to know on the back end that you've got a right priced asset that has value to the market. Quality of the building. We talked about older buildings. Again, they have a function and a lot of them work, but you want to understand the quality of that building. So you want to understand the condition of that roof, the structure itself, the power coming into it, the quality of that slab it's built on. All these factors are important, and we sign triple net leases where all of the responsibilities are on the tenant. But that being said, that's a real cost to the tenant. So when you're buying an asset, you want to understand what their costs will be in the future, because at the end of the day, that impacts their credit, their desire to stay in that facility. So again, the quality of building is critical. Importance of the business. I noted customer base. What are they doing there? Is it a profit center? Where are they drawing their employees from? Where are they distributing it out to? All those aspects you really want to understand of why that industrial space is critical to the location they're in. And that's a real estate fundamental to us. And then lastly, reuse. We sign long-term leases with tenants that traditionally renew. But that being said, if the space were ever to come back, you want to be very confident that there's market value to that location, to that box. So you want to look at the back end worst case scenario of where does the reuse of this facility? Will a competitor come in and operate it, or another completely different user, but because of its functionality, will have interest in it. So those are the real estate components. The second leg of the stool is credit. And really, I've thrown out some names and tenants that we own, but we really haven't addressed credit yet. This is so important because this is who's paying you your rent, will be paying your rent, and underwriting the quality of that credit. So a lot of what we do is investment grade. With investment grade, you're getting a company that is monitored by rating agencies. It's got a lot of media on it. You can do a lot of research to understand the quality of that credit. And because of that IG rating, there's some comfort level. But that being said, don't just hang your hat on the ratings agencies. Understand the direction that operator, that investment grade tenant is headed. Are they in growth mode? Are they downsizing mode? Is this a division of the business that makes sense? Just because you're a component of a much larger investment grade corporation, you really understand what you own through your tenant in your box and where that future is going. So I stress that on investment grade. But we also buy non-investment grade tenants. Some of our best credits are private companies. In that instance, you've got to get financial reporting, which we do for all of our non-investment grade tenants, and understand the makeup of the company, the balance sheet, how it's capitalized, where its growth drivers are. It's a little more work, a little more advanced because you don't have the benefit of these agencies, but you can go in and really underwrite a credit and get a good understanding of where they stand today, where they will be in the future. And a lot of these non-investment grade tenants we bought over the years have had credit enhancements where they've just gone, we call it upstream, to larger companies, and we've seen a growth in our credit, which helps on the exit pricing if you ever wanted to sell. So that's a real positive. And lastly, the lease. So we're on the third leg of the stool. The lease is your agreement for 10, 15, 20 years with that tenant on you will pay me this amount of rent, but these are the rules. I'm not paying you that rent. And underwriting the quality of the lease is critical. You've obviously got term, you've got landlord responsibilities, but not everything is triple net. Maybe you have a roof responsibility, especially on new builds. That's typical. That's okay. A lot of those come with long-term warranties, but who's providing that warranty? You need to really thoroughly underwrite that warranty to make sure that you've got a credit operator that's giving you that indemnity, that guarantee. And how long does it truly run and what components of the roof? And there's so much detail that goes into it. So really stress that just because you might have a warranty, understand it. Lastly, on the lease, I note landlord controls. A lot of this is baked into the lease. If you think about the financial reporting component I mentioned, you have a private credit, you want to have that obligation on at least an annual basis to receive those financials in a timely manner so you can monitor the credit of your tenant. Lease assignment. That's buried on page 30 of the lease typically, but that's the right to assign out that asset, potentially without landlord consent. So you want to make sure that they can only assign it to an equal or greater credit. They can never bury it within a subsidiary and try to get out of an obligation. So, it's one of so many components of a lease that you need to understand when you're underwriting, and you need to have the right counsel that also advise you on that and abstract those leases. So, and work with you to do that. We create a lot of our own leases where we're structuring it as a lease back, but we also buy existing leases and have worked tremendously with developers to say, this is what we need within a lease as a landlord, and they understand the value of exiting with a quality lease. So, a lot of what's in the market today are I would say landlord friendly, but well-balanced leases that give you these type of controls that you need.
Great. Taking a couple questions here from the audience. This is right in line with some of what you were just touching on, Jared. So what steps do you take to mitigate risks, such as tenant defaults, and during that acquisition process?
Yeah, and we talked about credit. So, under the credit, public, obviously, you're getting a lot of reporting and having a lot of support through the marketplace. That's giving you information on that. From a private, you're having to go through those financials yourself to really understand them. But monitor the credit, again, regardless whether it's in public or private credit. That means balance sheet, especially in this market, cost of debt, what's coming due, all those components that really drive the capital of these credits. But again, I noted what industry they're in, where the growth prospects, what's the location, how's that location impact their business. All those factors kind of help build your thesis around really why I like XYZ as a tenant in my space. If you see a problem, whether it's taking on a debt obligation, debt coming due with no real idea of where that recapitalization will be. Maybe it's a declining industry within an operator. If you anticipate problems, talk to your tenant. That's what I would stress. We're very active asset managers that are constantly in communication with our tenants. With the larger corporations, it is difficult, and you might not get the feedback you need, but make that effort because to build that relationship is so important. And in the end, if you really feel that the time is coming that there will not be renewal, maybe an asset might go dark, get ahead of it, talk to leasing brokers, start building your network to get out there. And if you bought it appropriately and you got value in your box, you'll have an attractive market that will want to start talking about that new opportunity in your space.
Great, excellent. And just circling back to another one here. It's I think a great flow to it. How do you address environmental and zoning concerns unique to industrial properties?
Yeah, it's amazing. And industrial used to be what we considered a dirty asset class because of what they do in these sites. They manufacture things, fall in boxes that fall on the floors, liquids, all these different things. So, it really was a smaller group that would buy into it because of those concerns. But you look today, everyone wants industrial in their portfolio. What they do there really hasn't changed, and you still have those environmental concerns. So it is critical that in looking at an asset, valuing an asset before closing on an asset, you do the appropriate third-party work to understand your risks and mitigate. From an environmental standpoint, that's having a quality firm do a phase one. And there are instances where you might need a phase two, but based on that phase two, things can be addressed to eliminate or limit your liability at that location. So again, third parties will do that process for you as well as your counsel. And at the end of the day, when it comes to environmental, will a lender accept what's happening to that property? Because that's ultimately who you want to accept the environmental reports is the lending community, so you can finance that property. But it's critical you do that. In addition, property condition reports, we do that in everything we buy, even if it's the full responsibility of the tenant. We want to know the quality of that roof. We want to know the quality of that slab. Even if downspouts have to be replaced, we go through all of that to understand what the CapEx for this future box will be. And in the case where it's a tenant's responsibility, we provide it to them. We say, listen, these are your future costs, so they're aware of it. You don't want your tenant all of a sudden getting these large bills, even though it's their responsibility, either coming back to you or having concerns over paying it. You want to anticipate all that. So quality third parties will do that. For us as a DST sponsor, we do all of these reports and we provide them in our war room to all of our investors so they can go through and read it themselves and make their own decisions. We really believe in having the best third-party providers, give us that level of comfort prior to closing on an asset. So we know that whether it's the investors or the lenders, they're all going to be able to access the same information and come up with the same conclusion that this is a quality investment.
Excellent. I think next question is a really great one that kind of ties this all together a little bit. How do you foresee industrial real estate over the next 5 to 10 years? And really, what should investors prepare for?
Yeah, I'm going to actually pull up a slide. It just shows you the volume of transactions. So according to Colliers in 2024, there was $90 billion in industrial transaction volume in the marketplace. Tremendous relative to where industrial has been in years past. So again, I stress so much of the benefits of industrial real estate, the players in the space, be it the large institution down to our investors, which are 1031 investors invest into our platform. At the end of the day, it's a quality asset class that has gotten everybody's attention. It's got tremendous growth drivers behind it. I think space will continue to be developed, and there'll be tremendous demand for it going forward. I think 24 is a little bit of a correction, but 25 with a lack of supply and the continued demand, I think it's going to be a good year for industrial. If you look at our space, so the DST space, in 2024, of the $5.7 billion raised in the DST market as far as equity, industrial was 30% of that. So it's really grown within the DST space as a desired asset class, and it's something that I want to continue to provide the highest quality product to.
That's what's interesting. That number's for the whole year, right? 2024.
Yeah.
Just looking more recently at the month of December, of the 524 million in DST assets raised, 41% was industrial versus some other asset classes like multifamily, which was at about 18%. So interesting to kind of see where assets have been going as of recently. But with that, I do want to thank everyone for joining us today, Jared. I want to thank you as well for joining. I really love hearing your insights from yourself and your team. I do know there were a couple other questions that were submitted, so I want to encourage everyone to visit our website, fscap.net. You can access wholesaler maps, connect with your case manager here at Four Springs. We'd love to coordinate, make sure we can answer these questions for you. I'd also want to share that Jared and his team, acquisitions team, they're always jumping on calls, meetings with our advisors, our investors. We're all about providing the best high quality white glove service and support we can to our clients. So thank you again, everyone, for joining us, and we're looking forward to speaking with you soon.
Thank you.